When we talk about diversification, most investors immediately think of owning a mix of stocks and bonds. But diversification today must go far beyond that, because the old models of correlation, risk, and safety have already been rewritten by technology, by geopolitics, and by monetary evolution. The global economy is no longer a simple interplay of cycles and commodities. It's an interwoven system of innovation, disruption, and digitization that constantly redefines value. In this new world, diversification isn't about scattering your capital. It's about intelligently positioning it where exponential change converges with scarcity and resilience. The traditional 60/40 portfolio that once worked so elegantly in the late 20th century has lost its protective power. We're entering an era where bonds are no longer reliable anchors. Equities are increasingly concentrated in a handful of mega caps, and currencies are undergoing structural shifts as digital assets gain legitimacy. To truly diversify now means thinking across dimensions, tangible and intangible, physical and digital, cyclical and exponential. It's not about owning many things. It's about owning the right uncorrelated exposures that can thrive in contrasting macro environments. Consider the relationship between innovation and scarcity. In the past, investors sought balance by combining high growth equities with defensive assets like gold or real estate. But what if innovation itself has become a defensive category? Companies leading the AI, genomic, and energy revolutions are not just speculative growth stories. They are productivity engines that could redefine efficiency, cost curves, and entire industries. Owning these innovators isn't just about chasing returns. It's about holding exposure to the future's foundational infrastructure. True diversification, then, means recognizing that certain exponential technologies now carry the same structural resilience that oil or steel once did. At the same time, diversification must include the material and the immutable, real assets that anchor value when confidence wavers. In a world of digital liquidity and algorithmic volatility, tangible assets like land, commodities, and infrastructure regain importance. They offer something that data cannot replicate: intrinsic physical utility. This is especially vital as inflation remains sticky and governments recalibrate fiscal priorities toward manufacturing, defense, and renewable transition. Owning exposure to these physical domains is not a hedge. It's an acknowledgement that the world is rebuilding itself in the real, not just the virtual. Currency exposure is another overlooked frontier of diversification. Too many portfolios remain tethered to a single fiat system, assuming its permanence. But the next decade may see parallel monetary architectures, sovereign currencies, stablecoins, and tokenized reserves, all coexisting. Holding assets denominated across multiple systems could prove as vital in the 2020s as holding multiple sectors was in the 1990s. This isn't speculation, it's adaptation. As the dollar's dominance gradually decentralizes, diversification across monetary ecosystems becomes not only smart but necessary. Geopolitical diversification also deserves rethinking. The investment world has long been U.S.-centric, but the growth dynamics of Southeast Asia, Africa, and Latin America are shifting dramatically. The diffusion of innovation AI hubs in India, renewable breakthroughs in Brazil, digital finance in Nigeria suggests that resilience may increasingly emerge from the periphery, not the core. Diversifying geographically is no longer about chasing emerging market beta. It's about owning pieces of the new global growth infrastructure. Finally, diversification now extends beyond financial assets into personal and intellectual capital. The most adaptive investors are those who diversify not only their portfolios, but their skill sets, networks, and information sources. The ability to pivot, to learn new systems, understand new technologies, and detect nonlinear change is itself an asset. The market no longer rewards passive positioning. It rewards curiosity, agility, and conviction built on research. So when we say diversify beyond the obvious, we are not merely recommending variety. We are redefining resilience. We're talking about portfolios built for transformation, not preservation. It's about positioning where tomorrow's inefficiencies become today's opportunities, where risk becomes optionality and change becomes compounding. The investors who understand that will not just survive 2026, they'll shape it. Quality and real assets have become the new language of preservation in an era defined by uncertainty, supply shocks, and shifting monetary realities. We are witnessing the slow unraveling of an illusion that paper assets, infinite liquidity, and low-cost leverage could indefinitely sustain growth. As global debt levels rise and the monetary anchors of the past are tested, the market is rediscovering the value of what is tangible, productive, and enduring. In this environment, quality and real assets are not simply safe havens. They are instruments of long-term wealth creation and purchasing power protection. When inflation erodes currency value and fiscal policies oscillate between stimulus and restraint, capital seeks assets that hold intrinsic worth. The simplest truth about inflation is that it punishes capital that stands still. Cash loses purchasing power, bonds lose real yield, and speculative assets suffer valuation compression. The winners are those that either produce essential goods, own scarce resources, or generate consistent real cash flows. These are not glamorous stories, they are durable ones. Farmland, infrastructure, high-quality industrial real estate, and resource-backed equities form the backbone of portfolios that can endure and adapt to volatile cycles. But quality doesn't only refer to tangibility. It speaks to discipline, governance, and durability of cash flow. In equities, quality means companies with pricing power, low leverage, and structural advantages that transcend cycles. In fixed income, it means issuers with robust balance sheets and transparent risk metrics. Quality is the compass that guides capital through inflationary fog. While speculative narratives can dominate short-term rallies, only quality assets compound sustainably over time. They survive liquidity squeezes, policy shocks, and the repricing of risk that typically follows long expansions. Real assets, on the other hand, form the foundation of an increasingly tangible global economy. The digital revolution, while transformative, still rests on physical infrastructure, data centers, renewable grids, semiconductor plants, and logistical hubs. These tangible investments are becoming scarce as supply chain constraints, higher construction costs, and regulatory bottlenecks limit new capacity. Scarcity drives value. When you own a piece of infrastructure that cannot be easily replicated, you own a store of utility. In an inflationary era, that utility appreciates because it remains indispensable while currency units expand. Commodities and precious metals, long dismissed during the years of monetary expansion, are regaining strategic importance. They serve not only as hedges against inflation, but as stores of real optionality. Gold and silver, for instance, hedge both inflation and systemic risks, offering confidence when trust in fiat systems wavers. Industrial metals like copper and lithium represent the backbone of the energy transition, forming the bridge between old and new economies. As policy and technology converge on decarbonization, these materials gain monetary and industrial significance simultaneously. They are no longer cyclical plays. They are strategic assets. Real estate, too, is undergoing a revaluation. The question is no longer about speculative flips or short-term appreciation, but about ownership of productive yield, generating space. Properties linked to essential economic functions, renewable energy sites, logistics networks, healthcare facilities, are becoming the real estate equivalents of high-quality bonds. They provide yield, inflation linkage, and physical relevance. As urbanization patterns shift and interest rate regimes stabilize, Such assets will form the quiet, consistent core of resilient portfolios. To navigate inflation intelligently, investors must distinguish between nominal growth and real growth. Nominal growth flatters revenues but conceals erosion of value. Real growth, growth in units of purchasing power, is what preserves wealth through cycles. That's why inflation hedges matter. They don't merely offset temporary price surges, they maintain real economic participation. Exposure to commodities, real estate, infrastructure, and inflation, protected securities, ensures that investors are not spectators to inflation, but participants in the value systems that inflation favors. In essence, the shift toward quality and real assets reflects a deeper transition in capital markets, from an era of abstraction to an era of substance. It's no longer enough to own claims on future promises. The future itself demands ownership of what endures, what produces, and what remains useful regardless of currency or cycle. These assets, rooted in reality, scarcity, and productivity, represent the bridge between the volatility of the present and the stability of the future. Volatility is not a threat, it is a revelation. It exposes what is fragile and highlights what is resilient. Every major turning point in history has arrived disguised as chaos. The dot-com bust, the 2008 crisis, the pandemic dislocations. Each was less an end than a recalibration of capital, technology, and human behavior. As we approach another regime shift in the global economy, it's essential to understand that volatility isn't just noise, it's information. It signals that the old models no longer fit the new data. It tells us where value is migrating and where opportunities are being born. The post-2008 era of ultra-low interest rates, abundant liquidity, and synchronized globalization is drawing to a close. We're entering a phase defined by fragmentation, supply chains regionalizing, monetary policies diverging, and technology accelerating faster than fiscal frameworks can adjust. In this environment, the correlations investors once relied upon will break down. The safe assets of the past may not act as stabilizers, and the risky assets of tomorrow may offer asymmetric protection through innovation, scarcity, or structural growth. Preparing for volatility means abandoning the illusion of stability and embracing adaptability as the new edge. Economic regime shifts often begin quietly. They emerge in the margins: rising input costs, wage stickiness, fiscal imbalances, or demographic transitions, and then suddenly become systemic. The period ahead could mark a transition from disinflation to reflation, from monetary dominance to fiscal activism, from digital optimism to real-world reinvestment. Each of these transitions carries both risk and opportunity. The portfolios that will endure are those constructed with flexibility, cross-asset awareness, and a willingness to challenge orthodoxy. One of the greatest mistakes investors make during volatile regimes is confusing movement with direction. Volatility compresses time, it forces reactions, but reacting is not the same as preparing. Preparation means understanding where the shocks will concentrate and where the adaptive mechanisms lie. For instance, higher rates may suppress speculative growth temporarily, but they also discipline capital allocation, steering resources toward genuine innovation. Supply chain diversification may raise short-term costs, but it also strengthens long-term resilience. Volatility, in this sense, is not the destroyer of wealth, it is the editor of inefficiency. To navigate regime shifts effectively, investors must shift their mindset from prediction to positioning. Prediction seeks precision. Positioning seeks preparedness. The future is rarely forecastable, but it is shapeable through intelligent exposure. Assets that thrive in nonlinear environments, those linked to productivity technology, real assets with pricing power, or cash flow based businesses form the spine of resilience. Holding optionality, liquidity, and diversification across innovation, hard assets, and global markets allows investors not merely to survive volatility, but to harness it. Currency volatility, too, will play a critical role. The next few years may redefine the global reserve landscape as emerging economies assert monetary independence and digital currencies mature. This could lead to higher cross-border capital friction, but also to broader opportunity sets. Investors who anchor in a single monetary ecosystem may find themselves blindsided. Adapting to a multi-currency, multi-asset reality where capital flows dynamically across sovereign, digital, and commodity systems is essential. It's not just about hedging, it's about participating in an evolving architecture of value. Behaviorally, the most dangerous response to volatility is paralysis. The human tendency to seek comfort in consensus is strongest when uncertainty is highest. But regime shifts punish complacency and reward conviction built on research and foresight. The ability to detach from noise, observe long-term signals, and act before clarity arrives will define the next generation of successful investors. Those who remain anchored to backward-looking metrics will mistake mean reversion for safety. The future, however, belongs to those who recognize that volatility is the price of transformation and transformation is the engine of long-term return. We are not entering an era of random turbulence, but of structural evolution. Technology, demography, and policy are rewiring the global system. Volatility is simply the visible tremor of that rewiring process. Those who prepare not by retreating into old models, but by aligning with adaptive, forward-focused assets will not just withstand regime shifts, they will lead through them. Markets are living ecosystems, not static machines. They evolve, react, and reprice with every day to point every innovation, every policy move. The greatest misconception in investing is that you can set and forget. That mindset belongs to an era when structural stability was the norm, not the exception. Today, we are operating in a world that shifts faster than any economic model can fully capture. Active awareness combined with disciplined rebalancing is no longer an option, it is the foundation of long-term survival and compounding. Awareness begins with observation. Too many investors watch markets but fail to interpret the deeper signals. A rising market can disguise concentration risk. A correction can obscure fundamental progress. Data can overwhelm, but insight comes from context. Active awareness means seeing through the noise, understanding that the market's narrative is often backward, looking while true opportunity forms quietly on the frontier of change. It's about maintaining the mental agility to question assumptions and the humility to adapt when new evidence emerges. The landscape we are navigating now is defined by complexity. Monetary cycles no longer move in predictable arcs. Technology is collapsing old moats and creating new ones overnight. Consumer behavior, supply chains, and capital flows are shifting in real time. In such an environment, portfolios that remain static inevitably drift out of alignment with reality. Assets that once hedged risk may become its source. What once offered diversification may become correlation. Awareness allows investors to catch that drift before it becomes damage. Rebalancing is the practical expression of that awareness. It's the discipline of bringing portfolios back in line with conviction, not complacency. When volatility reshapes relative values, rebalancing allows investors to systematically buy low and sell high, converting emotion into process. It transforms uncertainty into opportunity. Far from being a mechanical act, it's a strategic recalibration, an ongoing dialogue between conviction and caution. Without it, portfolios succumb to inertia, overexposure, and blind optimism. But rebalancing is not only about weights on a spreadsheet, it's about intellectual and emotional calibration. It means revisiting the C's, reevaluating risk tolerance, and reassessing time horizons. It means asking whether a position still aligns with the original reason it was purchased, or whether the world has changed enough to demand new reasoning. It requires courage to trim winners when momentum feels invincible and to accumulate laggards when sentiment is bleak. True investors rebalance not because they doubt their ideas, but because they respect the cycle. In periods of regime change, rebalancing becomes even more powerful. When inflation trends reverse, when interest rates pivot, when innovation accelerates in unexpected directions, static portfolios become obsolete. The investors who survive are those who maintain structural awareness, who recognize that every macro shift demands a micro response. They continuously realign exposures to reflect emerging leadership, emerging risks, and emerging value. This constant refinement doesn't dilute conviction, it sharpens it. The importance of awareness extends beyond markets into mindset. Emotional discipline is the cornerstone of rational rebalancing. Fear and greed will always distort perception, but awareness tempers both. It transforms reactive behavior into proactive strategy. When others panic, awareness allows you to see dislocation as opportunity. When others chase exuberance, it reminds you of mean reversion and valuation discipline. In essence, awareness is the immune system of a portfolio. It detects imbalance before it becomes illness. In the era ahead, automation, algorithmic trading, and AI-driven flows will make markets more efficient, but also more volatile. Information will move faster, narratives will shift overnight, and capital will reprice in milliseconds. Human awareness, strategic, interpretive, forward-looking, will become the differentiator. The investors who combine data with discernment, process with patience, and conviction with flexibility will consistently outmaneuver those who rely on passive positioning. Rebalancing and awareness form a loop, a constant cycle of observation, analysis, and action. They are the rhythm of successful investing in an age of disruption, because in a world that never stops changing, the only real risk is standing still.